So usually stock is issued for cash, right? Because the company wants the cash to use in their business. But sometimes stock can be issued for something other than cash, particularly a startup. They don't have a lot of cash in the beginning, so they may buy things by giving shares of stock. So here we have an example. They issued 4,000 shares of $20 par value stock to acquire land. They're buying land for $105,000. So we record the land at its cost, $105,000, but our credit to common stock, as we said, is always the number of shares times par. So we debit the land $105,000. The credit to common stock, 4,000 times 20 is 80,000. And then the difference goes into paid in capital in excess of par value. So here's another example of issuing stock for something other than cash. So as I said, a lot of times a startup company may, short on cash, may be issuing shares of stock to buy assets, or in this example, it's to pay the bill for organizing. So perhaps the attorney, the accountant, right? When you're getting your corporation together, any of those expenses you incur while you're setting it up before you start operating are called organization expenses. And so we're short on cash. We didn't pay the bill with cash. We paid our attorney with 600 shares of $15 par value stock. So we would record that by debiting organization expenses for $12,000. We credit the common stock for 600 times 15, comes to 9,000. And then the difference goes into paid in capital in excess of par. Okay, next we're going to take a look at cash dividends. So in chapter 2, we had this transaction, paid dividends for $200. Well, how did we record that? We debited dividends $200, we credited cash. Then in chapter 3, we learned to close dividends, right? Because dividends reduces retained earnings. We learned that in chapter 1. We debited retained earnings and we credited dividends. So that closed out, it zeroed out our dividends account, and it reduced retained earnings. Okay. We're going to see dividends are a little bit more involved than this. So typically, and board, not typically, the board does declare the dividends, but typically they declare the dividends and then it's not going to be paid until later. If you're a smaller corporation, it's possible that you might declare the dividends and then cut the checks or wire the money the same day, electronically transfer the money the same day. But typically, it's going to happen on different days. And so we're going to see what we're going to do here. Instead of using the dividends account and then closing it into retained earnings, we're just going to reduce retained earnings directly when the dividends are declared. So in order to pay a dividend, okay, we obviously have to have the cash because that's what we're going to use to pay the dividend. But because because dividends come out of retained earnings, we also have to have enough retained earnings to pay the dividend. Okay. And so here we've got 3 dates. Okay. The date of declaration. So at the meeting, the board declares the dividends. When the board declares the dividend, they have a legal obligation to pay it. So a liability arises on the date that is declared. So we have to make a journal entry, even though they're not going to pay it till later. So we're going to make a journal entry because we have to record that liability. Now, we're not going to pay it maybe for a few weeks. And in between, the stock can be traded. So who do we get? Who's going to end up getting the cash dividend? Well, they set a date of record in between the date of declaration and the date of payment. And whoever owns the stock at the close of trading on the date of record is the party that receives the cash dividend. Okay. So we don't have to make a journal entry here because it's just saying who's going to get the dividend, where do we got to send it. Okay. And then on the date of payment, we're actually paying the dividend. Okay. And so we're just basically paying off this liability that we set up on the date of declaration. So here's an example. On January 9th, a $1 per share cash dividend is declared, and there's 5,000 common shares outstanding. So the dividend goes on the outstanding shares, the ones that are in the hands of shareholders. The treasury shares will not receive the dividend. Okay, so they're not going to pay the dividend until February 1st. The date of record is January 22nd. So whoever owns the stock at the close of trading on January 22nd is going to receive the dividend. Okay. But as of January 9th, since the board has declared it, we've got a legal obligation to pay it. So we've got a we've got a liability, $1 per share times the 5,000 common shares. So we're going to debit retained earnings because we know dividends reduce retained earnings by the 5,000. And we set up a liability, common dividend payable, for 5,000. Okay, so that's January 9th. January 22nd, we don't make a journal entry. We're just looking to see who are we going to send this 5,000 to. And then on the payment date on February 1st, we're just paying off that liability. We debit the common dividend payable and we credit cash. Okay, so now we want to look at another form of dividends, so stock dividends. So it's the same idea. We're trying to reward our shareholders, okay, by giving them more shares of stock. So showing that the corporation is doing well and reward our shareholders. Okay, but we're going to see that the stock price is going to be affected when we issue these additional shares of stock. So if we have more shares of stock, right, and every share of stock is a unit of ownership. So if there are more units of ownership, right, so we're basically dividing up the corporation into more pieces because the corporation is worth what it's worth, and every individual stockholder gets a little piece of it. Well, if there's more pieces, more units of ownership, each piece is going to get a little bit smaller. So the stock price is going to go down when there's a stock dividend, okay? But each shareholder owns more shares of stock, so their investment doesn't change. It's just when this market price comes down, it makes it easier to trade. And so stock dividends can be classified either as a small stock dividend, and we're going to see the board is going to declare a certain percentage of the outstanding shares is what's going to be distributed in the stock dividend. So if it's 25% or greater or smaller, less than 25%, then it's going to be a small stock dividend. If it's over 25%, then it's a large stock dividend, and it'll be accounted for a little bit differently depending on whether it's 25% or less, a small stock dividend, or greater than 25%, a large stock dividend. So let's take a look at an example of a small stock dividend. So it's a 10% stock dividend, okay, and they have 10,000 shares of $1 par value stock. So 10% of the 10,000 is 1,000. 1,000 shares are going to be given out in the dividend. The market price, it's selling for $15 per share. So if it's a small stock dividend, we record the dividend at its market value. So 1,000 shares times 15, it's got a value of 15,000. So that's the amount of the dividend. That's the amount that's going to come out of retained earnings. And since we're not giving out cash, we're giving out shares of stock, that 15,000 is going to go into either common stock or paid in capital. So we can see the retained earnings gets debited for 15,000. That's the amount that comes out of retained earnings. We're not issuing the shares today. Okay? They're going to be distributed next month. So we're not going to credit common stock directly, but we're going to use a placeholder account called common stock dividend distributable. Okay? This is the amount that's going to eventually go into common stock when we issue the shares. So we're going to calculate it the same way we always calculate our credit to common stock. We take the number of shares, 1,000, times the par value, which is $1. And actually, I can see there was a typo. It said $1. It's actually $10. So 1,000 times the $10 par is 10,000. Right? That's how we get our credit to this common stock dividend distributable. And then the difference between the $10 par and the market price of 15 at $5 times the 1,000 shares in the dividend, that's the $5,000 difference, that gets credited to paid-in capital in excess of par. So here we can see the changes in the stockholders' equity account. Okay, so we can see the common stock dividend distributable goes up by 10,000. And see the paid-in capital in excess of par is going up by 5,000. Retained earnings goes down by 15,000. Now let's take a look at what happens when we actually pay the dividend by distributing the shares. Well, at that point, all we're going to do is we're going to take the amount out of common stock dividend distributable and put it into common stock, because now those shares have actually been issued. So we debit common stock distributable for 10,000 because that was the amount of the debit in the initial entry. So that'll zero out that account. And then we credit common stock, and the common stock account goes up by 10,000. Let's take a look at the large stock dividend. Let me correct that $10 par. So we've got 10,000 shares, $10 par, but now they declared a 30% stock dividend. So it's greater than 25%, so we're going to treat it differently. So 30% times 10,000, that means there's going to be 3,000 shares in the dividend. Instead of recording the dividend at the market value the way we did with the small stock dividend, now we're going to record it at the par value. So the 3,000 shares in the dividend multiplied by the $10 par value is 30,000 is the amount that's going to come out of retained earnings. We'll debit retained earnings, 30,000. Our credit to common stock dividend distributable is going to be 30,000 because that's the number of shares times par. This is the placeholder account for common stock, and so we calculate it the way we always calculate the credit to common stock, number of shares times par. And then when it comes time to distribute the shares of stock, we'll just debit common stock dividend distributable, 30,000, credit common stock, 30,000. So that's how you record a large stock dividend. Kind of related to stock dividends is stock splits. So we're distributing additional shares of stock to the stockholders, okay, maintaining their ownership percentage. So we're basically taking the shares of stock and we're splitting them into pieces. So a common one, a 2-for-1 split, every share is now going to be split into 2. So if you've got 1 share, now you've got 2. So what's going to happen to the stock price when additional shares are distributed, right? We said if there's more pieces of the pie, each piece has to get a little bit smaller. So it's going to bring down the price of the stock. And that's usually the reason for it, is when the stock price gets too high, we either need a stock dividend or a stock split to bring the market price down. If we look at like Amazon stock, it's thousands of dollars for 1 share. It's hard to find someone to buy, to sell a block of shares when each share is $1,000. So a stock split will bring down the market price. So we're basically increasing the number of shares, and then we reduce par value by the same proportion, and we'll see the market price will also be reduced by the same proportion. But if the stock is strong, it'll grow back up, and now those investors are going to have multiple numbers of shares, and now each share is going to climb back up. So that's how people become millionaires. So the new number of shares, we take the number of shares before the split, multiply it by the amount of the split. The par value, we take the par value before the split and divide it by the amount of the split to get the new par value. So $20 par common stock, we've got 100,000 shares, 2-for-1 stock split. 100 shares times 2, 200,000. $20 divided by 2, the par value is 10.